You are listening to Keystone's Stock Talk Show, episode 251. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. It's great to be back again this week after a successful research trip to Las Vegas. To start the show, I will hit the viewer mailbag and answer a question on CargoJet Inc. symbol CJT on the TSX, which provides time-sensitive overnight air cargo and all-in charter, as well as ACMI services through its fleet of 35 aircraft. The stock has been a long-term Canadian success story, but is well off its 2021 highs. And viewers ask if the current slump is a long-term opportunity. Aaron takes a look at Meta Platforms, symbol META on the NASDAQ, which has had a volatile month after a very strong rebound year. Meta, formerly known as Facebook, is of course a leading social media and technology company. Aaron takes a look at the stock in light of the recent quarterly numbers, which were strong, but its forward outlook felled the stock. Brennan reviews a company we interviewed in Las Vegas this past week, Byrna Technologies, symbol BYRN on the NASDAQ, a non-lethal defense company that offers handheld personal security devices and shoulder-fired launchers and projectiles, including chemical, irritant, kinetic, and inert rounds. Brennan lets you know how they screen from our management interviews. Finally, Brett answers a viewer question on Wajax Corporation, symbol WJX on the TSX, a diversified industrial products and services provider. The viewer asks if it is a good time to buy this stock, which provides a solid 5% yield. All right, let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How are you guys doing?
Good.
Doing well.
Yeah.
Doing good.
Aaron and Brennan, that guy. Have you recovered at all from Vegas yet? Are you back in the swing? Does it feel normal?
Okay. I think I'm doing okay.
I was there for 46 days, so it feels a little bit.
How many days were
I'm
you
still
there?
trying to get
being there for 8 or
9, which I would advise against.
Las Vegas. I mean, 3 days for
yes,
me. I'm
3 to 4.
Yeah.
Mm-hmm. I went ahead of time with my family, so we were there for 5 nights. And then I had a buffer in between, and then I had 3 nights with you guys. And that is a long time in Vegas. I was fairly sick of it by the end. I had a good time the first part, but as soon as you guys get there, it turned all downhill.
It did, as a matter of fact, it did.
It did. We had good interviews, more than anybody knows, right? But no, we had good interviews though at the event.
Yeah.
We did 16, 17. So
yeah,
I mean that was
17
good.
Interviews, wasn't it?
Mm-hmm. Yeah. Couple
Most
companies
together,
in current coverage.
We just did individually. We had to break up to get through all the companies.
Yes.
Yeah.
But it's good. And the organizer owes you guys a bottle or something, I heard. So we better hold them to that. Yeah. I haven't seen it yet.
I only drank the finest champagne, so.
And only during the day.
No,
right?
I mean, to be honest, like one thing I want to say about the event is that I remember, I mean, it's just in terms of the quality of company, it's improved so much over the years. Like I remember we went pre-COVID and, we did a couple of meetings, but it was really kind of a stretch to find companies that met our very stringent criteria of profitability and growth. Whereas at this conference, I mean, we had 17 companies that met that criteria, and
there was only a couple in there that we would have dismissed right away.
Yeah.
The others, it was interesting to listen to. Not of course, not all of them meet our full criteria, but
I'd say 5, 6 are like serious contenders.
Yeah, which is high even when we go to conferences like where there's 400 companies, right? And this one had about 100 in that range. So the Planet Microcap in Vegas this year was relatively successful. So it's good. If you're going to spend the time to go there, it's always good to at least have some companies to interview. So we had that, and I got more tired when we left than when we got there. That's always what it is in Vegas. You're exhausted after you leave. It's not really a vacation ever. All right. We had a poll from a couple weeks ago. Brett, you're going to tell me what the hell that poll was, right?
He has no idea. So the poll was nice and simple.
2 weeks ago.
Yeah, from 2 weeks ago, because these guys had to run off on their Vegas journey, and I had the most relaxing week of my life. So the poll was, do you use derivatives, options, futures, etc. in your portfolio? 19% of our audience said yes, and 81% said no, which is about what I expected, even maybe a bit higher. I'm surprised 20% or so said yes to it. Because most people you ask, they've never touched it. They don't even know what a derivative really is or an option is in the most cases. When you're talking about stocks, it'll be options. And people don't really touch them for the most part. The most I find what most investors will start to have exposure to is now covered call ETFs. That's their kind of first exposure these days to some sort of a derivative, at least if they're managing their own money. So yeah, I don't know if you guys have any thoughts on that.
I was a little surprised it was that high as well.
Yeah, I mean, I did say yes, but I mean, realistically, how often have I used options in my portfolio? Well, since 2019, basically, that was like the starting of my investing journey. Once out of, I've held, several companies and made, multiple investments, but, there was only once which I ended up, buying a put on the S&P, and it was a speculation essentially, so I kept it as a small piece of my portfolio. But that is why I said yes. Is because,
how did that do?
It actually did well. I think the
100% success rate.
So far it's 100% success rate, but just wait. I'll do it again eventually, and I'll lose my shirt.
And probably a lot of people that would say yes have used options, once, twice, handful of times, maybe out of, how many hundreds of typical stock trades. So.
Yeah.
Good. Okay. Well, we might as well kick right into the show. We'll maybe talk a little bit next week about some of the other companies that we interviewed at the event as well. Sprinkle that in over the next couple weeks of the show. But let's get right into this segment. I'm going to talk first about CargoJet. Okay, CargoJet, symbol CJT on the TSX, trades around $121, $1.98 billion market cap, pays a yield, but it's small, just over 1%. What does CargoJet do? They provide time-sensitive overnight air cargo and all-in charter and ACMI services through its fleet of 35 aircrafts that carries payloads of 80,000 to 125,000 pounds. For those unaware, and that should be most of you, ACMI services is also known as damp or wet leasing. It's an agreement between two airlines to provide an aircraft crew, maintenance, and insurance. Now, CargoJet operates the largest Canadian domestic overnight air cargo network spanning coast to coast. The company operates out of its main base at John C. Munro Hamilton Airport and currently employs around 18,000 employees. Let's look at CargoJet's all-time chart back to February 2020 or 2011. Excellent long-term growth. You can see here. You can see the stock all-time is up over 1,200%. Now let's go forward there. Okay. If we look at the 5-year performance, however, you can see it's decent, but with some challenges here. And the stock has certainly moved off its highs from 2011. Now let's look at the 10-year operating or revenue and operating profit track record of the business. Not surprisingly, the revenue and profitability tracks the stock price performance for the most part. Strong growth in revenues from $192 million in 2014 and operating income of $4.9 million, going to $970 million in revenues with operating income and profit of $172.9 million in fiscal year 2022. As revenues and operating profit have moved lower over the past 2 years, however, so has CargoJet share price. Let's take a look at the most recent quarterly results on the company here. We can see Q1 fiscal year 2024 total revenue was $231.2 million compared to first quarter of the same year. Prior was 231, so basically flat year over year. Adjusted EBITDA for the quarter was $78.4 million compared to about $75 million in the same period of the prior year. Net earnings for the quarter were $32.5 million. Net earnings of about $20.8 million, excluding warrant valuations and contract asset amortization, compared to net earnings of $30.5 million. That would be net earnings of $9.8 million, excluding warrant valuation and contract asset amortization. So now, if we move forward to the balance sheet on the company, cash is about $20 million on the balance sheet. Debt is about $675 million. Net debt is then $654 million. And net debt to EBITDA is 2.6 times, so that's a healthy net debt to EBITDA margin. Valuations on the stock here, in summary, on EV to EBITDA or adjusted EBITDA basis, about 8.7 times. Forward looking, about 8.2 times. PE right now trailing is 55 and forward is about 24. So my conclusion here, near term, there's a cautious outlook. A robust economy essentially aids this business as far as the current volume outlook. There's some hesitancy seen in consumer spending that was experienced in Q1 of 2023. That was the low point. It has improved somewhat throughout the year. However, management remains, in their recent conference call, they said they were cautious given the increased geopolitical uncertainty and potential for supply chain disruptions. Overall, valuations are improving, but with the stock trading at about 25 times next year's earnings and limited revenue growth expected, the stock, for my money right now, is fully valued at present.
Sure. I mean, we actually had coverage on CargoJet many years ago in our income research. It's been quite a while right now, and I don't know the current status of its contract with Canada Post, but the stock initially, when you saw that big uptick in the share price, maybe 5-7 years ago, that was due to the signing of a huge contract with Canada Post. So I believe that's probably going to be coming to a conclusion soon, if it is not already, and that could be something that is impacting the outlook for the company.
Yeah, I mean, there's certainly been long-term growth in the business, and I think they got kind of that post-COVID bump, but it's normalized to a degree, and it probably has deserved a premium because of its long-term outperformance. But right now, and for the past 2 years, you've seen lower earnings, lower revenues, and it's just kind of flattened right now. I think you would need significantly more of a growth outlook for me to pay 25 times earnings for the stock right now. And so, from that perspective, I think it's just a fair value right now. They're doing some asset sales too of some of the planes, so perhaps reducing some of the debt, because the debt has, it's 2.5 times forward-looking adjusted EBITDA. So it's not unheard of to see a company trading at those multiples, but it is, I don't think there's going to be many acquisitions in the near term coming when you're levered up to that degree. And of course, debt has become more expensive. On the flip side, if you did see rates come lower, that's going to help this company, and you could see some better profitability, as they also have some cost-cutting initiatives in right now when I was reading through a couple of reports on the company. So, something to definitely keep an eye on, but I think a lower multiple being paid or higher growth would have to be there for us to be back in on the stock. Okay, now we're going to move forward. Aaron, you're going to talk about Meta.
Happy to do that. Take another look at Meta here. Okay, so we're going to take a look at Meta, which just recently put out its Q1 2024 results. Meta, of course, is the owner of Facebook, Instagram, and WhatsApp. It's the largest social media company in the world. They had also recently, the name of the company was Facebook, but they changed their name to Meta as part of their transition to focusing on the metaverse, or virtual and augmented reality. They invested a lot of money in that, both from a branding perspective and from a technology perspective. So right now the company is trading at a price of $460. It's a $1.2 trillion market cap. They're one of the mega cap 7 companies. So very, very influential in the market, yielding a little bit, but only about 0.1%. So fairly insignificant yield. Now, I actually did a Your Stock Our Take on Meta when they put out their Q4 results, but I decided it was probably time for us to take another look at the company, just given the market reaction to the company's Q1s. So the first quarter results were released on April 24th. And subsequent to the results, the stock pulled back about 13%. So obviously the market was seeing something that it did not like. Now, previous to the release of the results, the company had a tremendous trend of growth over the previous year, one of the top performers on the market, and very strong Q4 results, which put the year-to-date numbers at a high level. But why don't we take a look at the Q1 results and see what's going on here and see what it was that the market was seeing to cause the share price to fall as it did. So Q1 2024 results, revenue was 36 billion. That was up 27%. Income from operations up 91% to 13.8 billion. And then the operating margin, a big increase, 1,300 basis points to 38%. Earnings per share of 471, up 114%. So at face value, these numbers look incredibly strong. What was it then that caused the share price to decline after the release of the results? Well, what the issue was primarily was weaker than expected revenue guidance for the second quarter of 2024. So the company issued Q2 2024 guidance for revenue between 36.5 and 39 billion. That's 37.75 billion at the midpoint, and that was just moderately below, about $500 million below what analysts were forecasting for Q2 revenue. So when we look at the midpoint of the forecast, that would equate to about 18% year-over-year revenue growth in the quarter, and that compares to 27% revenue growth in the in the first quarter of this year, the one that just came out, about 25% in the fourth quarter of last year, and 23% in the third quarter of last year. So we've seen a decline in the growth trend here, and that's really what has the market concerned. Now, I think this is somewhat of a fickle reaction, because in spite of the fact that revenue growth is trending lower, it's still fairly strong, looking at growing about 18% year over year. And I can't imagine that many investors would have been expecting that revenue growth would just continue to trend at 25+% for a company Meta's size. Most rational investors would understand that growth rate would moderate over time. In addition, the guidance for the year as well. I mean, the high end of Meta's growth forecast or revenue forecast for the second quarter is actually above what analysts were estimating. So, but this is just an example when a company has a huge run. If there's any level of disappointment, that a lot of people that have made money, they want to take profits, because they're kind of betting on more and more good news and an acceleration of the trend, as opposed to a slowing of the trend. So one of the things that is a major focus of Meta right now, I would say the major focus of Meta right now, is artificial intelligence. Of course, every company seems to be focusing heavily on artificial intelligence, but Meta is one of those few companies that actually has a very strong competitive advantage within this space. So they've announced that they're significantly increasing their investments into AI into 2024. They're planning a $35 to $40 million investment in AI related activities. So one might ask, well, why is Meta focusing so much on AI now? Well, there's 3 reasons that we would focus on here. One is to directly improve its existing products. and that would be Facebook, Messenger, WhatsApp, Instagram. So using AI to augment the user experience there. Another is developing new products and services. So they want to look at developing new AI-powered virtual assistants, AI-generated content, all with the focus on supporting their existing infrastructure and business. And really, it's necessary for them to invest heavily in AI at this point in order to keep up with other tech giants like Google, Microsoft, and OpenAI that are making huge strides in this space. So now in the past, Meta's focus was on the metaverse. That was what they targeted as like the big growth engine for the company, even changing the name of the company to Meta. But now there's a lot less talk about the metaverse. The investments that they've made into augmented and virtual reality have not really paid off. We've not really seen much of user adoption in that space. And now they're shifting here to have more of a focus on artificial intelligence. But I will say that their focus on artificial intelligence has been very successful so far. The company just recently released in May their Llama 3 AI model. And this is the state of the art for open source large language models. It's actually competitive with ChatGPT and GPT-4, although it is substantially smaller. So there's two versions of Llama 3. There's the 8 billion parameter version. There's the 70 billion parameter version. Now, compare this to GPT-4. I don't believe that they officially disclose how many parameters are in the model, but the estimates that I see are about 1.5 trillion. So quite a bit bigger. I won't get into the technicals of what a parameter in a large language AI model is, but the mentality of the past was that bigger is better. But now we're looking at a model with 70 billion parameters that is in many ways competitive with GPT-4 at 1.5 trillion approximately, and is exceeding GPT 3.5, which I believe is about 170 billion parameters. So that's a huge advancement. And the great thing about Llama 3 that a lot of people love is that it is open source. So as opposed to the OpenAI models, those are closed source. You can access them through an API, but you can't take the models onto your own system and train it and work with it, fine tune it. Whereas with an open source model, you have a lot more latitude to actually just take control of that model and do what it is that you want with it. But I've tested the Llama 3 model. I was quite impressed given the size of it. And, in the past, I've just found the open source models have not been as quality as what OpenAI, the ChatGPT and the GPT-4, but Llama 3 appears to be right up there. So I was quite impressed. And the great thing, anybody can go and test it out anytime they want. You just go to www.meta.ai. You may need a Facebook account. I'm not sure. Most people have that. But you can test that, do image generation, all sorts of things. But now getting back to the financials, in terms of what the company is expected to do going forward. So analyst consensus, the midpoint of the consensus estimate for 2024 this year is $20 per share. That would be growth of 35% over last year's earnings. And then looking forward into next year, 2025, analysts at the midpoint are expecting 15% growth to $23.10 per share. So this puts Meta's stock right now at about 23 times earnings based on current year's estimates and 20 times based on next year's 2025 estimates. So what is our take on Meta? Well, I mean, it obviously has a leadership position in social media. It's propelled itself to the forefront of AI research, arguably the best open source model available right now. Highly profitable company, great track record of growth. It also has a cash-rich balance sheet, and it's trading at a reasonable valuation. So a lot of good things to say about the company. On the other side, social media trends, they can be very fickle. I've talked about this in the past. There's fewer young people on Facebook, more so on Instagram, but it's actually all of the young people that I know through my family seem to be into TikTok and Snapchat, and not so much into Meta's Facebook or Instagram. So that's a concern. How do these social media tastes trend? And as young people take over the market more and more, do we see more of a migration away from Facebook and Instagram? There's regulation. There's always regulatory hurdles, all big spotlight on social media companies. One of the things happening right now is there's recently legislation passed in the United States, which is forcing TikTok. I believe it's forcing the parent company of TikTok, one of the biggest competitors to Meta. It is owned by a Chinese-based company, so it's forcing them to divest their U.S. business, or it faces a ban in the United States. I don't know where that's going to turn out. There's concerns about security here. This can work two ways for Meta. One, it reduces Meta's competition in the U.S. market if this were to actually happen. But it also opens Meta up to further scrutiny as well, because there's other factors in that legislation that could impact Meta negatively potentially. And then, of course, there's retaliatory measures. Typically, when one country issues regulations that benefit a company that is based in that country, then there's retaliation. I don't think that Meta is very big in China. I know that they are in China with restrictions, but that's something that is a concern, is the regulation. And then there's the substantial investments that they have to make into technology. Right now, it's AI. Before it was metaverse, they made a big bet on the metaverse. It did not seem to work out. Maybe it does over the next 10 years, but they have to constantly be investing in their technology and trying to figure out where the trend is going. So right now, AI is the focus, but very uncertain outcomes. A lot of money being invested in that technology, but even Meta confessed that it may take time before any of that is apparent in terms of value for shareholders. So you just don't know. And in terms of competition, there's just so much competition in the AI space, and things change very quickly. But our take on Meta, really, if you look at the company, the numbers, it is a fundamentally strong business. It does fit the GARP model, growth at a reasonable price. So, I wouldn't argue against somebody who wanted to buy it. We do have a couple other companies that we prefer within the mega cap 7 that we're sticking to, but certainly Meta has some good characteristics.
Yeah, I definitely think like the Llama 3 is pretty interesting. Like I saw actually just on my way back from Vegas that they had updated. If you go to the top of Facebook or the top of Instagram in the search, it shows, where you can ask the Meta AI essentially, or the Llama 3, anything. And like, just for a quick example, I'll show my screen here, or get Brett to pull up the images. But basically I asked it, imagine a race or a car race on Mars. Here you go. So it gives me, an image of a car racing on Mars. I said, change to a Subaru racing on Mars. And then it gives me, a brand new STI, or one of the new Subaru WRX STIs racing on Mars. So it's pretty interesting. And it did a pretty good job. I was actually pretty shocked at how quick it can do it. But anyways, just to show what it can do.
Mm-hmm. No, that's interesting.
You should have put yourself in that Subaru.
Put Brennan.
Imagine Brennan in the Subaru on Mars.
Yes.
You could never imagine Brennan in a Subaru. It wouldn't happen.
No, it wouldn't happen. No, it's true. All right. Yeah.
On their actual like the metaverse hand, it's actually interesting because Apple, with their Apple Vision, it's in the same augmented reality space. So you have virtual reality, then augmented reality, which is placing it over the real world. So Meta doesn't have any augmented reality, I don't believe, but they do have VR, and they would probably push into augmented reality. Apple actually, they cut their forecast of their Apple Vision Pro from about 800,000 units for 2024, 2,400 to 450,000. So they cut it in half of what they're expecting to sell. So AR, at least at their $4,000+ price tag, isn't really selling to many consumers. It's not selling it as well as they expected. And I think that's that trend it's a hard thing to sell. I've talked to Brennan about this many times, it's something very different than a phone, because at this current point, is because you can't have it on. The Apple Vision Pro only has a 2-hour battery life. You can't have it for 12 hours a day. It's not attached to you in the same way. And I think that's what many people who were really in the metaverse, who thought like that your VR goggles or whatever, they've become like a new phone. I don't think that's happening, at least at this current technology level. So Meta, for example, they've invested $46 billion since 2021. That's the headline number I could pull quickly, at least, when they bought Oculus, which is their VR division, a decade ago in 2014, they paid only $2 billion for that. They've invested over 20 times as much. And I was hearing more headlines around that 2014 timeline about Oculus than I do for the augmented reality or virtual reality these days. So it's interesting to see like the consumer demand and interest in it. At least in my opinion, what I've seen personally, it seems to have dropped off for, even though they've spent over 20 times as much in the last few years. Like it's actually interesting how that's played out.
Yeah, I mean, maybe the technology has to advance to the point where, you know, the headset is more like a pair of glasses, so somebody can actually walk around with it. And then maybe that, you know, the phone powers it through Wi-Fi or something. But it's you know, it's interesting because I heard a speech from Sam Altman, who's the CEO of OpenAI, and he was talking about the difference between like a true trend and a fake trend in terms of like a product. And he actually used virtual reality as an example of a fake trend. And the way that he described it is that, you know, a real trend initially doesn't need to have that many users, but the users that it uses that product a lot, right? So when the iPhone first came out, it didn't really have that many users, but whoever owned the iPhone was basically married to it, right? Whereas, you know, a fake trend is one that everybody talks about. It may have a lot of adoption in terms of like a lot of people have the product, but they don't make it a part of their life.
They don't use it enough.
Yeah, and exactly. And that's kind of the example that he gave with VR, is that he knew, you know, countless people that had VR headsets, but they just didn't seem to be that obsessed with them, right? So I thought it was a good way of looking at it.
I mean, I'm an example of that. I have one, and I haven't probably used it in a year and a half.
There you go. So there you go, right? Yeah. Whereas I can say there was almost when the iPhone first came out, I mean, different thing, but whoever had an iPhone, nobody was saying that they never used it. They were basically trying to find ways to spend more time on it.
Or your BlackBerry, right? Your Crackberry.
I had a BlackBerry.
I did as well, actually.
Yeah. Well, everybody used the hell out of them too, right? So it was, at that
I remember
time,
BBM, which was like their messaging went down for like, it was like a week or something.
It was over.
And it was over.
The world fell apart.
The end of it. Everybody was started switching to iPhones in grade 10 and 11.
The only other trend that's as powerful is our mugs. And I can see Aaron, can't even put it down.
You know, there you go. It's it doesn't have as many, you know, owners as the iPhone, but
when they get it in their hand,
you know, they're obsessed with the mugs.
So keep your questions coming in, and you too may experience one of those mugs, right? And if you've got any questions you want us, or polls you want us to do, you know, send those in as well, and we'll put up a poll as well, because we're always thinking of new ideas, and we always need more. We're getting tons of questions in for Your Stock, Our Take, and all of those. But if you want a poll, or if you want us to battle about a company, let us know. Next, we're another company that we just interviewed in Vegas is Byrna. Is it Byrna? Is that how we say it? Or
Byrna, yeah, because the CEO is Brian, so I think that he just switched around couple letters and in his name. So yes, Byrna Technology.
I see what he did there. Okay.
Yeah, I'll take it away here. So BYRN on the NASDAQ, currently trading at a price of $14.02, about a $306 million market cap. And Byrna is a non-lethal defense technology company that offers handheld personal security devices and shoulder-fired launchers and projectiles, including chemical irritant, kinetic, and inert rounds. I believe about 90% of their sales are from like their hand launchers, whereas 10% is from their shoulder, like more rifle launchers. So yeah, I did interview the CEO, Brian, last week in Vegas, and he gave me a good rundown on the history of the business. So just to catch everyone up to speed, Byrna went live selling its Byrna hand launcher in July of 2019 and was selling a few kits per day. And they started really getting some traction after they paid some YouTubers to review the gun, which increased the website sessions and sales. But what really gave them a dramatic boost in traction was when Sean Hannity from Fox News endorsed Byrna on his show. But given the supply chain difficulties following 2020, the company was having difficulties fulfilling orders, but they have since added capacity and are doing better now. And this was kind of a change as well. At the end of Q1 of 2023, they got notified by Facebook and Google that they could no longer advertise their non-lethal launchers on these platforms. So as you can see here from the image that I have up on the screen, website traffic took quite a hit in Q2 and Q3 of 2023. But they did pivot with a focus on celebrity influencers to spread the word of their products. And on top of Sean Hannity, they ended up getting successful partnerships with Judge Jeanine Pirro, Bill O'Reilly, and Glenn Beck, which have delivered pretty impressive return on ad spend, or ROAS, of more than 5 times. So looking at the financials, it's also important to note that the company sells direct to consumers and also to law enforcement agencies, but a majority of revenue comes from direct to consumer channel. And looking at the last quarter, which was Q1 of 2024, revenue was up 98% to $16.7 million, which was driven by the advertising strategy change made last September. Adjusted EBITDA was $1.2 million compared to a loss last year. Net income was a gain of just $17,000 compared to a loss of $2.2 million in Q1 of 2023. But if we look a little deeper here, the only reason for the GAAP net income was essentially due to a gain of $280,000 in interest income because they have net cash on the balance sheet, which we'll go over shortly. And cash flow from operations was a gain of $3.9 million compared to a loss of $3.4 million for the same period last year. And looking at the valuations, trailing 12-month EPS and adjusted EBITDA were negative. So just looking at a price to cash flow basis here, the stock trades at just under 30 times cash flow. And moving to the balance sheet, it remains very healthy with $22.4 million in net cash, which equates to about $1.02 net cash per share. And when I asked management about the potential use for cash, they said possibly for opening up more stores, as they did open up a Byrna retail store in Las Vegas, which has had good success. And they also said that they would probably use the cash to add more capacity. So to conclude here, overall, I think that Byrna has good trajectory in its financials. The business is growing its revenue via celebrity endorsements, has been growing or has been cash flow positive in the last few quarters, is just about break even on a GAAP net income basis, and possesses a strong cash-rich balance sheet. Plus, I did question management. They said that they do believe that they will be, GAAP positive or GAAP profitable in the coming year. Now, the company has continued opportunities selling to law enforcement agencies, and it also is bringing on a new compact launcher product, which could appeal to more consumers, such as women who want a smaller device. But I think some risks that I would like to highlight is that, right now, sales growth is reliant on these successful celebrity endorsements. And given the company is potentially looking to open up more Byrna retail stores, this is a risk if the storefronts are less successful than the Byrna store in Las Vegas. Again, I like the trajectory of the business. It is a little early, I would say, for our GARP investment strategy, but it's certainly a name that I will continue to follow and hopefully interview Brian again at a future date. And, maybe he's going to be in Las Vegas next year for the Planet Micro as well. I'll definitely be booking a call with him then.
So how does this actually work? So this is a non-lethal projectile?
Yep.
So it's like a rubber bullet.
Yeah, exactly. Basically a rubber bullet. I mean, they have different kinds, but basically a rubber bullet. And it's
not
again,
a stun
CO2.
gun.
No, not a stun gun. No, exactly.
Yeah, it looks like it's your whatever rubber bullet and then CO2 cartridges.
Yeah, exactly. Yeah. Exactly.
Mm-hmm. It is actually interesting because so it looks like
too, Ryan.
Oh, you can go.
Sorry, keep going. No, you go.
So it does look like it's actually available in Canada. That would be something which I would be wondering is where the regulations matter in different countries, because some countries you obviously can't own a handgun or very limited access. So could it sell there? Could that be an alternative there, which could appeal to those markets as well?
I'm
Yeah,
guessing
that could be
that would be regulated up here in Canada. If it's available up here, like, do you know if it's available to consumers? Because my guess
it says legal in
it
10
is.
provinces.
Yeah,
Really?
it looks like
legal.
I can ship it. So
Most of their sales are in the U.S. though. So
yeah, well, of course,
but
yeah,
yes, they are. Yeah.
so
Exactly.
legal in
That's
10
awesome.
provinces, and you don't have to have a firearms license.
No,
That's what it says. Yeah.
Okay.
no, you do not. But yeah,
I think as far as the financially, I think you pointed out it's a bit early for us because the earnings, and the cash flow isn't where we'd like to see it right now. That's why we interview these companies in advance, keep a book on them. And if they hit an inflection point, or if they hit a point where we think they're trading at reasonable values and have growth going forward, then they might make it into our research and be a recommendation to our clients. This is one that we just continue to monitor over the near term and see if they do hit that. All right. Finally, today we're going to move on to Wajax Corporation. Brett has his take on this diversified industrial products and service provider that just had a quarterly set of results out, and the stock kind of came off from there, and we'll tell you why.
Exactly. So, like Ryan said, Wajax symbol WJX on the TSX is a diversified industrial products and services provider. The corporation operates an integrated distribution system providing sales, parts, and services to a broad range of customers in diverse sectors in the Canadian economy, including construction, forestry, mining, industrial and commercial, oil sands, transportation, metal processing, government and utilities, and oil and gas. So, effectively, any industrial, any equipment, they'll either service or sell a part to some degree. They have a quite wide range of products and services to do with that. So the stock is currently trading at $27.89 and has a market cap of $610 million. The stock is trading down 7.5% year to date. The stock was performing well, trading upwards about $34, but then the Q1 earnings caused a quick, sharp decline. So the stock traded about $6 down from that, about 20%. And the stock does offer a solid dividend yield of about 5% as well at the current price. So let's look at Q1 earnings to see why the stock actually declined. Revenue declined 6.5% to $482 million from $560 million. Management notes that the fall was due to the decline in the construction and forestry equipment sales in both Western and Eastern Canada. Notably, the other segments outside of equipment sales, so product support, parts, engineering, repair services, and equipment rental, were all materially flat, effectively within 1% of the same revenue as the prior year. Gross margin, however, increased to 22% from 20.4% due to that beneficial product mix, which they sold higher margin products. Notably, SG&A increased 4.3% from $79.3 million to $79.3 million from $76 million, or to 16.4% from 14.7% of revenue, respectively. So you had revenue drop while the SG&A actually increased. So you actually get a higher percentage of SG&A compared to revenue. Adjusted EBITDA as well decreased 5.3% to $40.7 million from $43 million. And the net income decreased as well 15.8% to $14.7 million. As well, EPS, of course, declined 16.5% to 68 cents from 81 cents. On the upside, the backlog has increased by 33.1 million or 6% to 587.1 million since the start of the year, or 10.6% since Q1 of last year. Overall, it's a weaker quarter. Industrials are cyclical and sensitive to macroeconomic changes such as interest rates and overall economic growth, and as well as those industry fluctuations. The company has stated that they are looking into expand into less cyclical industries as a core part of its growth strategy, but for now it is quite sensitive to those cyclicalities. But if you do get out of those, you do end up seeing smoother earnings instead of these quarterly and yearly variations. And that is something that investors like. You don't like that fluctuations, as it is harder to predict, and you normally get less of a multiple when it is these cyclical companies. So shifting to the balance sheet, debt has grown to $356 million with additional leases of $186 million and cash of $2 million. Cash levels are always lower, even effectively nothing, as they use financing for their normal day-to-day operations. Debt levels have, since the end of last year, they have increased since the end of last year. They were only $330 million since the start of the year. We have seen higher debt levels and lower EBITDA, so that results in a higher leverage ratio. And their leverage ratio currently, not including the leases, is at 2.2 times now, which is out of their management target range of 1.5 to 2.0 times. So overall, you want to see that actually decrease because that is quite a high leverage ratio because you're not including the leases in that ratio as well. The core reason is that for their EBITDA and their debt increase has been inventory has increased 18.4%, 160 million to 747 million, up from 631 million at the end of last year. The increase was in part due to an early delivery of heavy equipment. So they took in that shipment, meaning they have higher inventory, meaning they have to take on more debt because they finance all their working capital. So therefore, you have your higher debt, higher inventory. So those two are in line. When they take on higher inventory, they take on higher debt. Management does, however, stated expects shipments to increase as the backlog has increased. So they do have at least sales lined up over the next 2 quarters and will largely revert this higher inventory buildup. As well, the company did launch on March 1st, which it was in the last quarter, but not materially, a new financing program, which they do expect will help with sales. And if that does come, you'll see that in the next couple of quarters. So a quick look at the dividend. Wajax has began to grow its dividend again over the past couple of years and currently pays a quarterly dividend of 35 cents, resulting in a 5% yield. The trailing payout ratio compared to net income is 36%, which is a maintainable level. Given that they don't have a significant downturn in earnings, there really isn't much of a dividend risk at the current conditions. That being said, the company has had previous times of volatility in their dividend prior to the last decade, where you'd see a cyclical decline in oil and gas. They'd cut their dividend, they'd reinstate it, it'd grow a bit again, then it'd be cut, and so on. So that is something which you do want to watch whenever a company does has exposure to cyclical companies, because you can have these dividend cuts and hikes and the cuts and hikes over and over again. They do at least have seemed to be more stable now. They have that about 8 years where they had a flat dividend and now they're growing again, which is good to see. But I would be slightly cautious, although I wouldn't consider it a near-term risk. You normally do have a bit of foresight if a company like this will actually cut their dividend. But moving to valuations, Wajax trades at a PE of 8 times and adjusted EV/EBITDA of 7.1 times. Industrial equipment and services never really trades at a big premium, but it is at a bit of a discount compared to the rest of the industry, and that's likely due to the recent weaknesses and the heightened debt leverage. Even if only temporary, the stock is probably near fair near-term value. So that is not, even though it is an 8 times PE, I wouldn't really jump in on that as it is normally not trading at a significant premium. Concluding, the recent drop in the stock is justified, but does have a chance at recovery if the management is able to move the inventory, which would then lower their debt, lower their leverage, and make the company overall more appealing. The valuation is not overly appealing at this time, but the dividend is likely safe given at least the current macroeconomic conditions. But just due to the industry they're in, there is always the risk if there is a prolonged recession. It is a company that could potentially, in that scenario, need to cut its dividend. Wajax is at the whim of those cyclical industry it supports, and when coupled with the debt, it really creates volatile financial and adds risk, which is why you never will get those 20-time multiples or anything like that. When you're getting around that 10-time multiple, that's likely in a normal, where it's not in a cyclical downturn like it is right now for some of its industries. A 10-time multiple is probably a good gauge, as well with heightened interest rates right now compared to previous years. That will weigh on these companies as well, because their end markets get weighed on by interest rates, and of course they have debt which gets hit by interest rate as well, so you kind of get that double effect. For now, I just really hold off on Wajax, but if their inventory is able to move in the next couple of quarters, allowing for lower leverage, it could become more interesting, assuming that the macroeconomic backdrop doesn't significantly deteriorate.
Yeah, I think the low multiple is just a lower margin distribution type business, right? And that's what you get in these type of businesses. I think the adjusted EBITDA multiple or margin was about 8-point-something% in that range. Yeah, so it would be on the lower end of a lot of the companies that we look at. But, it's been a decent performer over the long term. But we probably look for a better margin and a little more growth, and the growth isn't there. So it's probably, like you said, after the drop, closer to fair value than anything significantly undervalued.
Yeah, I mean, Wajax, we followed it in our income research for a while. It's always traded at a low valuation, so it's not something where I think you'd go into it expecting to see that valuation multiple increase.
Yeah, it's always great to have a company where you could have a multiple increase plus growth, right? That may have to get re-rated going forward. I mean, you can't always marry those two, but if you could marry those two, then you can really have a powerful move. Yeah, it would be ideal.
Nice thesis.
For sure. Good. All right, I think we're done for the week, unless there's another person who's looking to present. You got anybody in the background that you want to come out and present? I think we're good. Next week we may review a couple of companies that we talked about in Vegas as well. But as always, keep your questions coming in for your stock take. If you are watching this on YouTube, smash that subscribe button right now. If you're listening to it on iTunes or wherever you get your podcast, rate and review us. As always, only positive reviews. Thank you very much, and I'm going to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.